Have you ever wondered what it takes to move the entire global stock market? You might think it's some huge world event or groundbreaking new technology, but sometimes it's just one number. And today, we're going to break down how one single number did exactly that, becoming the most powerful force in the market. And here it is: 85%. Just last week, this one figure popped up on trading screens everywhere, from New York all the way to Seoul, and it kicked off an absolute firestorm. So you gotta ask, right? What is the big deal with 85%? What does it even mean? And how on earth did it trigger such a massive, instant reaction from investors all over the globe? All right, let's get into it. To really understand the power of this number, we have to go right to the source. And that source is a quiet but super important signal from the US Federal Reserve. I mean, just look at how fast this all happened. That 85%? That's the market betting there's an 85% chance the Fed will cut interest rates in December. Now get this, just a week before, that probability was sitting at only 42.2%. That is a huge swing in what everyone's expecting, and it basically happened overnight. So what happened? What caused that huge shift? Well, it was something investors call a dovish signal. Basically, some recent comments from Fed officials hinted that the U.S. labor market might be cooling off a bit. And for the market, that was like a giant blinking sign that said, hey, the Fed might start lowering interest rates soon to keep things moving. Okay, but how does a probability, just an idea, an expectation, suddenly make billions of dollars fly around the world? Well, it's all about a concept called pricing in, and I've got a great way to think about it. Let's imagine you're planning a massive outdoor music festival, right? Your success, everything, it really all comes down to the weather. For months, the forecast has been pretty gloomy. A high chance of storms. That's kind of like high interest rates. So naturally, everyone's being cautious. Then, all of a sudden, the forecast changes. Bam! An 85% chance of guaranteed sunshine. What do you think happens? Of course, everyone rushes to buy tickets, vendors prep their stalls, they're getting ready for an amazing day. That is exactly what just happened in the market. The promise of sunshine, in this case, lower interest rates, sent investors rushing to buy. And this buying frenzy wasn't just happening on Wall Street. Not even close. Let's take a look at how this wave of optimism went global. The result? It was just a sea of green on trading screens everywhere. In the US, you had the big ones, the S&P 500 and the tech-focused NASDAQ, both climbing higher. And this good mood totally spread. Over in South Korea, their main stock index, the KOSPI, shot up more than 2.6%. And listen, this wasn't just a couple of big stocks doing all the heavy lifting. The buying was across the board. On the New York Stock Exchange, for every single stock that went down in price, you had more than 4 that went up. That's what you call widespread confidence. And this rising tide really did lift a lot of different boats. You had the AI giants like NVDA, who need a strong economy to thrive, making a big comeback. But at the same time, you saw retailers like Urban Outfitters jumping too. That's a sign that investors are feeling good about people going out and spending money. And you can see that global impact in the numbers. We're talking about a direct and measurable effect. On that one day, foreign investors poured about 359 million US dollars into the Korean KOSPI index. Just that one index. That's a massive vote of confidence from around the world. And that money flowed into some really key areas. The strength in US tech, for example, gave a direct boost to Korea's huge semiconductor companies like Samsung and SK Hynix. At the same time, Korean financial stocks also got a nice lift, helped along by some government programs designed to make them more attractive. Okay, but here's where we kind of need to pump the brakes a little. This entire rally, all of this excitement, is built on an expectation. A really powerful one for sure, but it's still just an expectation. And that right there has its own set of risks. There's a great line that sums up the whole situation perfectly. The market is basically running on the high-octane fuel of hope right now. So the real question becomes, what happens if that hope doesn't turn into reality? Let's go back to our festival analogy. What happens if that 85% chance of sunshine was just wrong? What if some new data comes out? Maybe inflation is hotter than we thought, or the jobs report is too strong, and the Fed decides not to cut rates. Well, all that guaranteed sunshine could turn into a nasty storm real quick, and everyone who bet on a sunny day would be caught completely off guard. And so that leaves us with the big final question, doesn't it? With all this optimism already baked into the prices, is it possible the market is getting way ahead of itself? Has it bet too heavily on a future that is anything but guaranteed? That is the multi-billion-dollar question every investor is trying to figure out right now.